Warm welcome to all of you, braving the traffic caused by disruptions, the reasons for which we are not very clear about. But thank you all for coming. I would first of all request our President to welcome Dr. Rajan with a bouquet of flowers. I would now request our President, Mr. Kiran Karnik, to say a few words of welcome and to introduce the speaker.
Good evening and welcome to you all. Special welcome to Dr. Rajan. This is part of our annual Habitat lecture series, and we're indeed pleased and delighted that Dr. Rajan has agreed to spare time and come and join us today. Many of you would have been here for last year's talk, which was actually earlier this year, when Dr. Kalam was here. We had the good fortune of getting him, and we've, I think, kept very hard tried and succeeded, I think, in keeping the tradition of getting really the best possible people, the most eminent people, and the most thoughtful people to come and share with us their views and thoughts as we move forward. I just want to spend a couple of minutes, not more than that. I know we are here to hear Dr. Rajan, and he's very kindly agreed at the end of his talk to take some questions, and I'd like to keep as much time for that as we possibly can. I know many of you have suffered the traffic coming here, and many other folks, I got a number of messages saying they're stuck. I was told the traffic is very, very severe today because everybody is heading around here, all the cars are here, and I was wondering why. And somebody told me, Rajan is here. So I said, Dr. Rajan, very good, I'm delighted. I mean, he is a bit of a rock star, especially, I was telling you, when I don't see his photo in the paper, I think it's the wrong day. The media just loved him, and he could have taken up a different job and been a movie star, but he chose to do something more useful. But I thought maybe it's that, because last year, some of you would recall, we had such overflowing crowds for Dr. Kalam, and I said, once again. And then I must tell you that I'm delighted to see this kind of crowd, but that kind of crowd was for a different Rajan, and I hope you know that. And I'm told he's sort of round the corner here, and very appropriately called Chota Rajan. So I don't think this Dr. Rajan needs any introduction to any audience in India or indeed in most places in the world, and certainly the professional community is nothing at all. What I'd just like to say is that for all of us from Delhi, it's a matter of pride that he's a graduate from the IIT Delhi, which sort of roots him, whether he likes or not, in Delhi. We call him a Delhiite for that purpose. And so welcome to a Delhiite. Subsequently, he went to something on which I hope he and he will agree, the best management school in the world, the Indian Institute of Management at Ahmedabad. You agree, Dr. Rajan? I hope you do. And then, of course, he went and did a PhD in MIT. He's been professor at the Booth School in the University of Chicago, spent years at the IMF, written books and pieces, very famously predicting the problems that the world economy and the US economy in particular went through. Very well known for that. An extremely well known economist. And I think the best thing I can say without getting into detail is that a very eminent person said that Dr. Rajan is very likely to be the first governor of any central bank in the world to get a Nobel Prize. We will all hope for that. He's abandoned a bit of his academic pursuits in the interest of serving the country. He's been the chief economic advisor before becoming the governor, and he's been the governor of the Reserve Bank for 2 years, and all of us know what he's done there. I just want to stop with the introduction there and then invite Dr. Rajan for give his address, and at the end of that, as I said, we'll have some questions. Dr. Rajan.
Thank you very much for that kind introduction. Thank you for inviting me here this evening. And I'll skip all the Chota Rajan, Bada Rajan jokes, which I think are rife nowadays. So while I was asking Mr. Karnik what I should speak on, he said, well, we sort of know your views on the domestic economy. Why don't you talk about what's going on in the world? And so that's really the focus of my talk today, and of course I'd be open to questions. I think the starting point is it's very hard to understand what's happening in the world economy. Okay, so why is that so? We're 7 years after a global crisis. It was a bad one, but 7 years after a crisis, you usually feel that economies get back to growth, reasonable growth. But we haven't seen that. We've seen very, very slow growth, punctuated by disruptions in Europe, now in the emerging markets, but also the single biggest economy in the world, the United States, keeps threatening to grow. Every year, by the end, we expect next year will be much better. And then we get a miserable quarter, the first quarter typically, and this time even further. So something is going on which we don't fully understand. I'll talk about potential explanations a little later. But the other aspect that one has to keep in mind is, even while growth is slow, there's tremendous pressure for growth, both in industrial countries and emerging markets. And I'll talk about the reasons for this. But you have sort of an unyielding object, which is growth, and an irresistible force, which is the need or the demand, the public demand for growth. And what happens when you have an unyielding object and an irresistible force? Something has to give. And I would argue that what gives is policy. That policy now essentially has moved in a direction across the world which is trying to give the illusion of growth, trying to create the illusion of growth, but may in fact reshuffle growth around. And that is really a palliative. Not just a palliative, it actually can make things worse. And I would argue that some of the crises we've seen in the past could be attributed to similar kinds of policies. So where I want to end is, all this suggests that in these kinds of environments, we really need a rethinking of what should govern, what rules of the game should govern global policy. Should it be a sort of free-for-all as it is today, or should we go back to some kind of a policy structure which is governed by global institutions based on agreed-upon rules? And I would argue there's certainly some rationale for going in that direction, given what we see happening around the world today. So this is where I'm going. Let me start first with the question of why is industrial country growth so slow? So typically, when you see a recession, it's deep, but the recovery is also equally steep. Okay, that's the typical recession and recovery, usually because inventories build up, production is cut back as the inventories are built up. Then you find that because of low production, inventories are drawn down, and so it comes time to start rebuilding again, and things get better. Now, this hasn't been the typical recession in industrial countries because it has been accompanied by a significant amount of debt, over-levered balance sheets in households, in firms, and in governments. And because, I mean, debt need not be a real problem if you're willing to write it down. If you're willing to write off excessive debt, it doesn't need to be a problem. But if lenders are unwilling to write off debt for a variety of reasons, including political, it could be a problem because your households which want to consume can't consume because they have debt payments to make. Your banks which want to lend can't lend because they have over-levered balance sheets. And your corporations which want to invest can't invest because they themselves have over-levered balance sheets and have to make interest payments rather than invest. And we've seen some of this in our country also, but certainly this is a possible explanation for what's going on around the world. Now, that said, if in fact debt is holding back growth and you can't write down debt, there are alternatives. Perhaps you can stimulate growth by getting the less indebted parts of the economy to either invest or to spend. And therefore, a lot of people post-crisis advocated various kinds of stimulus, fiscal stimulus, for example. And a number of countries undertook massive fiscal stimulus packages, including India. They spent a tremendous amount in an attempt to restart growth. But very quickly, a number of industrial countries ran out of space to do more fiscal stimulus because they found that the government debt load had increased tremendously. And they had to cut back because government debt itself was coming under question, as, for example, countries like Spain and Italy. Now, the IMF mantra has been, okay, those without fiscal space maybe should stop spending, but the rest should spend. And the right thing to do is, in this time, spend on infrastructure, which will be a long-term investment and will pay back over the long term. And so if there is weak global demand, let's create more demand by spending on things that you need over the long term. So the IMF exhortation across the world has been build out infrastructure. Also, it's cheap at times like this because labor is cheap, labor is available, cost of raw material is low, steel, cement, all that is low. Why don't you build those projects? Now, for a country like ours, it's pretty straightforward that we need more infrastructure. It makes sense to build out infrastructure. Of course, the difficulties are in things outside of infrastructure, such as permissions, such as land acquisition, and so on. Some of those problems exist in industrial countries also. Nobody wants a highway running through their front yard. But they have a bigger problem, which is they already have built out a lot of infrastructure. So what is obvious to them is repairing the existing infrastructure. Everybody in the United States will point to potholes around. They'll point to the decrepit status of some of the airports. But repair doesn't take a lot of money, doesn't consume a lot of, doesn't create a lot of employment. New infrastructure does that, but it's not clear where you build out the new infrastructure. And so in industrial countries, example Japan, when you build out the new infrastructure, often it tends to serve vested interests, serve pork barrel interests. Some politician wants to build something in his backyard, but doesn't necessarily add really needed infrastructure to the country and increase the rate of growth. So these are often not well thought out projects and don't create long-term sustainable growth. Instead, what they create is more debt. Because the government took debt to finance the infrastructure, you've created a project, not much value from that project. Classic example of this in the United States of a project that was thought of as new, interesting, but hasn't really taken off is high-speed rail. One of the most important things about high-speed rail is it's meant to connect two cities which are not so far away, but have large populations which sort of commute from one city to another on a regular basis. Now, for example, Los Angeles and San Francisco would be good places to connect through high-speed rail. But often the high-speed rail is mooted for poorly connected but poorly populated areas because, that's where the political will is to put them. It's easy to buy land and to do the high-speed rail, but it doesn't pay for itself. And in the long run, creates more debt than value. And so the bottom line here is fiscal spending. After the initial burst post-crisis has run out in some sense, partly because a number of countries couldn't do more given their high debt loads, and partly because there wasn't anything that was clear, immediate, that could be spent on, that would generate value in the long run. So, what do you do if you can't do fiscal spending? I think another alternative has been, let's see if we can bring down interest rates and get monetary policy to push the economy forward, right? And the idea here is that in the developed countries, Investment is still very low, and savings picked up post-crisis. So if savings are high and investment low, and you want to get up demand, you want people to spend more, and you want people to invest more, the ideal policy is bring down interest rates. Bring down interest rates because they don't want to save more. People don't like to save if interest rates are low. And with low rates of interest, people will invest more. And both those would pick up. I mean, savings would come down, investment would pick up. That's what economists basically say. This is a situation where the neutral rate or the natural rate of interest is lower than the current rate, push the interest rate down. Okay? So monetary policy could also do some lifting in order to spur growth in the industrial countries, and that was what the central banks did post-crisis. But very quickly they found that they could push down interest rates but not beyond a point. Once you get close to zero or slightly below zero, you can't push it much further. This is what is called as the zero lower bound problem. You can't have seriously negative interest rates because nobody would put their money in the bank to get negative interest rates. That means you're getting less back in principle compared to the money you put in. So what do you do if you have seriously negative interest rates? Take cash and put it under your mattress, right? Or if you've got too much cash, you hire a security company, buy a safe, put the money in the safe, and put the security company to have guards around it, right? Costs you less if you... Today, for example, in certain Scandinavian countries, the interest rate is negative 0.75%. So if you are a large investor with $100 million, it costs you $750,000 to just keep your money in the bank. So rather than keep your money in the bank, you take out the money, put it in a safe, as I said. Safes don't cost that much, and have a 24/7 guard around it. And maybe that will help you, right? So the point is you can't reduce interest rates below a certain level. And given that they have done all that they could on conventional monetary policy, and yet you don't see investment picking up, the central banks are thinking we should do something more. We should do unconventional policy in order to push down rates. I'll come to that in a little bit. But also you must ask, why hasn't investment picked up when people are willing to actually give you money for close to free, right? If interest rates are close to zero, they're basically lending you money for free. Why isn't investment picked up with such low interest rates? And one possible answer is anybody investing doesn't think they can recover their money. That any investment, even at zero interest rates, is a negative NPV investment, net present value investment. What are the situations in which that can be the case? When you think that there's already excess capacity and demand is very low, so it doesn't really make sense to put more investment in the ground. So one possibility is that demand is thought of as very low. Why would people suddenly think that demand is really low? Why would business people in the industrial countries think demand is really low? We don't fully understand this because 7 years after a crisis, they should be thinking things are picking up, they should be investing. And perhaps part of the answer is this is an aspect of aging that we haven't fully understood. Because one of the countries which has been in deep slowdown for some time has been Japan. And maybe what is happening in Japan is now playing out across the European countries and perhaps even across some countries in Asia. For example, China is growing old very quickly. So maybe what we are seeing is low demand reflects the fact that people are getting older. We've already got factories to produce for everybody who's around. As the population shrinks, there will be excess capacity because these factories aren't producing. There aren't enough babies to consume this stuff, and therefore investment falls off. Perhaps. Another possibility is that we can put investment into the ground, but productivity is very low. For a variety of reasons, we haven't seen productivity pick up in industrial countries. And if you can't have reasonable growth in productivity, perhaps profitability over the long run will also be low. So, these are explanations that are given for low demand, but there's a third explanation, which is that, perhaps in doing all this stimulus, you are creating conditions which will be troubling over the medium term. So you've kept interest rates really low, financial asset prices have gone through the roof, there are all sorts of distortions there, everybody fears what happens when central banks start raising interest rates. You're a worried firm, you don't know what will happen then, better not invest right now. Keep your capital structure safe, build a bulletproof balance sheet, start investing once these policies abate and you get back to normalcy. So in the new normal, it may be that people are so worried about the policy structure that they in fact don't invest despite zero interest rates. So these are examples of why people don't invest. There are also questions about why people are saving so much. Why the counterpart of a relatively low investment but also low consumption is higher savings and capital account surpluses which are sending to the rest of the world, which is happening in the industrial countries. So why has savings also not fallen with such low interest rates? And again, aging may be the culprit. If people are aging and they also think that some of these governments have high debt loads, they're not going to be able to fulfill their promises of high social security, high pensions that they promised in the past, as well as good health care, you basically want to provide for yourself. And you provide for yourself by increasing savings. So that's one possibility why savings are still relatively high with such low interest rates. Another possibility is it's partly a result of the crisis. The crisis had an enormous effect on equity prices and so on, and people who had their money invested and during the crisis may have suffered a large wealth shock. They would have also suffered a wealth shock if they had housing, which fell in price. So these people might think, I want to retire. I don't have enough money because my nest egg got wiped out, and I need a certain retirement goal. And as you push interest rates lower and lower, they're getting less and less on their fixed income assets. So they say, I need to save even more in order to make my retirement goals. And in fact, savings increases rather than decreases as you reduce interest rates. So the point here is, we're in a world we don't really understand. And there are all sorts of possible explanations. Of course, we have to weigh them and see which one is more important. But it is quite possible that the very low rate we're keeping right now, rather than moving us towards a place where savings fall and investment goes up, may in fact be doing the opposite. May be creating the conditions for higher savings and lower investment. We don't know, but these are possibilities. So, I talked about fiscal, I talked about monetary, neither seems to be the answer. We've spent many years trying to do both. Now, both kinds of interventions are meant to be a bridge towards strong, sustainable growth, where when temporarily the economy is in difficulty, we lift it through stimulus so that it goes back to stronger growth. But what if the real problem is the underlying growth, for a variety of reasons that we talked about, is really low? How do we get these stimulus packages to work when everybody knows that they may not be enough, that the underlying long-term growth of the global economy has fallen? And this is where the point about productivity comes back. It may be that productivity growth in the world economy has fallen off because some of the big inventions we had in the past have been rolled out, that some of the inventions today will take a long time to make their way into growth. Twitter, Facebook, all these things don't necessarily increase economic activity so much. And therefore, we are in a period of very slow growth for a long time. We'd better find other ways of growth rather than stimulus or debt-fueled growth. And here you run against the political constraint. And I think this is best reflected in Jean-Claude Juncker's statement. We all know what to do, that is, what to do on structural reforms. We just don't know how to get re-elected after we've done it. So, I think that says it all. That structural reforms are difficult. They typically involve hurting some segments of society immediately. Those segments vote. The segments that are to be benefited are usually segments that are unidentified right now, don't really know they'll be benefited, but down the line get benefited. Example, today, if you liberalize the taxi business in Paris, the existing taxi drivers immediately know their business will be hurt because the Uber guys, the other taxi apps will come, and guys who haven't traded for many years, who haven't bought their licenses, will compete with them, drive down taxi prices. So they know immediately they'll be hurt. But who knows that they're going to be an Ola or Uber driver down the line? I mean, these are kids working in university today who might decide suddenly making money by driving a cab is actually better than being an executive. And so right now they don't know. I mean, they first have to get into that lousy job first, the bad job, where they're at the bottom of the totem pole doing photocopying for somebody, and find that stuck in an office, for 9 hours a day, photocopying is not that much fun. Better be out in the open driving an Uber cab, right? So the point is, it's very clear who's going to be hurt by the structural reforms, much less clear who's going to be benefited. This is the wrong kind of equation from a political perspective. Political perspective, you want immediate gains, the pain should be down the line, right? But structural reforms, immediate pain, gain is down the line. And therefore, it's the wrong equation politically, which is why Jean-Claude Juncker made his statement. So, can't do the stimulus because we've run out, doesn't seem to be effective. Can't do the structural reforms because they're too painful. So why not accept lower growth, right? So this is a real question. Industrial countries are a very good level of per capita GDP, right? $50,000 per capita in the US. Plenty of money. Plenty of money. Why do you need to grow at these levels? Why not stay happier? Of course, beautiful countries, lots of open space. Park in the, why do they really have to go hell to skelter for growth? We do. We're at 1,500 per capita. We need to grow much more in order to have enough to eat and enough health care for everybody. But they're already there. And I would argue there are at least 4 reasons why they need to move. One is too many promises have been made in the past when growth was strong. We talked about the entitlements. The biggest burden in the United States today is entitlements, which are not likely to be delivered upon given current growth paths and given current taxation. Entitlements like Social Security, which is their pensions, as well as healthcare, just unaffordable. So, in order to be able to pay these in the future, you need growth. Otherwise, you might as well start writing down all these promises. So government promises, including government debt, which has built up to 100% of GDP in a number of countries, 200% of GDP in Japan. To pay this down, you do need growth. Second, I talked about average per capita incomes. But this per capita income is not evenly distributed. There are people who are employed, the insiders, the older people. They've got a good deal. They're going to benefit from the promises that were made because the promises don't run out when they retire. The people who have a raw deal are the youth today who are largely unemployed and who will never be able to recoup the promises that were made because all the money will run out by the time they retire, right? So bad for the youth, good for the insiders who are already employed. No wonder youth unemployment is a huge issue across Europe. It's a huge issue in the United States. And the young are very anxious and to some extent angry, which is why many of them are supporting populist left and right-wing parties, because the populists always have an easy answer to the problems that they have. So, second reason why, other than government promises, is distribution, insiders with outsiders, youth outsider, the elderly, and the middle-aged insiders. And then there's inequality. That is, even within the middle-aged people, there are those who have skills, there are those who are unskilled, or moderately skilled. If you were working as an auto worker during the just before the Great Recession, you're probably laid off now, and you haven't been able to get a job because a significant number of job cuts took place in the auto sector. So the moderately skilled have moved down into lower skilled jobs, gardener, hamburger flipper, all those kinds of jobs. While the skilled, the guys who have an Ivy League education, have a second degree, are working as consultants, as lawyers, and so on, have a much higher quality of life, much higher incomes. There's a big divide opening up in industrial countries as a result of globalization, which has taken away the low-skilled jobs, and technology, mechanization, computerization, which has again taken away the routine jobs. That leaves the high-skilled, non-routine jobs, and those high-skilled, non-routine jobs typically require strong education. There are also low-skilled, non-routine jobs. Those low-skilled, non-routine jobs are increasingly getting mechanized once again, just like driving a car. Maybe 10 years from now, driving a car, being a taxi driver is probably not going to be a viable occupation because we'll have driverless cars. So the point here is inequality is also increasing. Given that inequality is increasing, the need to create good jobs also increases to keep people at least moderately happy. And so once again, the need for growth, because any unit of additional growth is not creating the same number of good jobs today as it was in the past, so even more of a need for growth. And the example here is, something like Google may substitute for so many libraries, may substitute for so many cinema halls, etc., as a source of entertainment, but it employs only, how many people? 30,000 people? Something like that. 30,000 people displacing 300, 400,000 people. So we are becoming much less job intensive. Keynes predicted this in the 1930s. He talked about technological unemployment, and he said that would be a good thing, because once we produce enough, we can all take a holiday. The problem with technological unemployment, however, is distribution. That the gains to technology go to a few people, which gives us the enormous question of how to spread it to the rest. Now, from an economic perspective, this is pretty straightforward. Just take it from the rich, give it to the poor, no problem. But then you look at the details. Take it from the rich, well then the rich no longer have an incentive to innovate, to produce, etc. So it's easier said than done, but this is a problem that we face today. So, we need to grow. And the last part of why we need to grow is central bankers. Central bankers in industrial countries have gotten very worried about deflation because they think deflation was a source of tremendous problems for Japan. It's important to avoid deflation, and in order to avoid deflation, they better get growth going. So, we have low growth for almost a decade now since the crisis, and some people argue that we're now in the third phase of the crisis. The first phase was the subprime crisis, migrated to Europe as the sovereign bond crisis in Europe, and now it's migrating to emerging markets as the corporate crisis in emerging markets as they have high debt. So we have a crisis which is morphing across the world, and it's the same crisis. And it's taking the world into a very slow growth. So what do we do here? How do we move ahead? Well, everybody's looking to everybody else to step up. We need somebody to grow faster and pull the rest of the world along with it. But nobody's willing to step up. So how do we step up? How do we force somebody else to step up? Let's try and give them a push. And this is where the unconventional monetary policies come along. If we can't grow ourselves, let's try and take some of the demand. Let's try and depreciate our currency relative to their currency. If we depreciate relative to their currency, their people will buy our goods. As they buy our goods, we get pulled along, we get taken along. So let's sort of force these guys into providing some growth to us. Now, this seems far-fetched. Why is any country doing this? I would argue some of the unconventional monetary policy we've seen from some of the large reserve currency areas, may in fact reflect this, that some of the fundamental underpinnings of growth in those areas is not that monetary policy is spurring a lot of domestic investment, but that monetary policy is depreciating the exchange rate, making it easier for those countries to export outside, and essentially taking demand from other countries. Now, is this a safe environment where countries are trying to depreciate vis-a-vis each other and, in a sense, trying to borrow growth? Problem is, it isn't. It isn't. Because the way this happens is, I do some very unconventional monetary policy. What that does is generally capital flows out of my country, exchange rate depreciates, capital flows into my neighboring country, that country's exchange rate appreciates, and as a result, I get some growth for a little while. But in the process of doing this, that country's fragilities increase, because as capital flows into that country, as real estate prices increase, people start demanding too much, debt levels increase, and that country becomes more and more fragile. Now, I would argue that if you think about this as the model for growth, it reflects what's been happening for the last 20 years, and in fact reflects the various crises we've had since then. Think about the early 1990s, when in order to boost domestic economy, which had been hit by previous debt crises, industrial countries led by the United States cut interest rates to the bone. Cut interest rates, capital flowed out to the emerging markets, flowed out to Latin America, flowed out to Asia. Those countries said, wow, this capital is coming in, we love it, let's go and build new cities, let's go and build new airports. Malaysia did a lot of it, Thailand did a lot of it, except when interest rates started going up in industrial countries, once they'd fixed their economies, the capital wanted to flow back. First country to go under was Mexico, the Tesobono crisis. After that, we had the Asian financial crisis, again when capital flowed out. Then we had the Latin American crisis. So a variety of crises in the 1990s. At which point the emerging economies said, you know, perhaps we shouldn't be doing this. When the capital comes in, we shouldn't absorb it and build big new cities. We shouldn't borrow a lot. Instead, what we'll do is we'll send it back out. We'll build up reserves, okay? And so there's an enormous wave of reserve building in the Asian countries post-financial crisis, but also in some of the Latin American countries as they got religion. Where did this money go? It went back to the industrial countries. And so now the industrial countries had a lot of capital coming in. Those of you who are students of economics may remember Ben Bernanke's famous Global Savings Glut speech in 2004-05, when he said the United States was facing an enormous wave of inflows from emerging markets building reserves, and this was distorting asset prices in the United States. And he was right. It was distorting asset prices, and as a result, building the conditions for the financial crisis that eventually came. But it distorted asset prices not just in the United States, but indirectly through a variety of channels in Europe, where countries ran large deficits. So in 2007-08, we had the big crisis there. And the industrial countries said, we can't do this. We can't keep absorbing capital. Let's stop doing it. Let's send capital back out. The extraordinary accommodative monetary policies they had, which sent capital back to the emerging markets. And the emerging markets, once again, forgot the lessons of the past, did massive stimulus packages to spend the money, and look who's in trouble. Brazil is in trouble, China is in trouble, Russia is in trouble. We've, I think, tried to pull ourselves out of the trouble we were in, and we are, I think, making some headway. But across the emerging markets, you see the consequences of absorbing the capital, and the capital now wants to go back. A number of countries in difficulty, large depreciation in the exchange rate. So we have this problem in the world of musical crises. We're sending a crisis from here to there to everywhere. Nobody wants to be the venue for the crisis. Very hard to avoid it. Okay? I think monetary policy is partly responsible for all this. And we need more stable, sensible monetary policy. Which is why I have personally been saying for some time that QE1 was good, but beyond that, harder to find effects. and similarly with some of the other accommodative monetary policies across the world. That it's probably good for the world if we brought all this to an end, because it would allow more normal asset prices to establish. But there is a difficulty in coming out of these extraordinary policies, because if in fact the extraordinary policies were partly responsible for keeping your exchange rate depressed, when you reverse the extraordinary policies and you're the only one doing it, your exchange rate appreciates considerably, and that serves to slow down your growth. So we're really in a situation where everybody's deep in the well, and if you're the first one to try and climb out of it, everybody catches out onto your foot, and therefore it's very hard to climb out. It's what is called a prisoner's dilemma for those of you who know economics. Nobody wants to be the first person out. And I think this is a great source of problem. So I've talked a long time about the problems. Let me talk quickly about potential solutions. I mean, clearly the world has depressed demand, and we need to expand demand. And clearly, we need to expand demand where it's most needed. To my mind, demand is most needed in the emerging markets, or is most possible, I should say, in the emerging markets, especially through infrastructure investment. A country like ours could do massive infrastructure investment for the next 10, 15 years and still not be done. We have enormous projects we could do. But really, the key here is to attract patient risk capital. We have a deficiency of risk capital in this country. The guys putting up the equity for the large projects. Many of our projects are done with too little equity, over leveraged. We need more risk capital, sensible patient risk capital. One source of sensible patient risk capital are the large multilateral banks, but they haven't been given too much money to lend in the past, and that's something. Their energy inefficient plants need to be replaced. And by rights, it is the industrial countries who should be making these investments, given that the stock of carbon out there is largely a consequence of their past activities. And therefore, green technology being used and implemented in industrial countries could create a wave of new investment, which I think they could certainly pay for, they probably should pay for, but will also help us in the longer term goal of limiting climate change. I'm not saying that emerging markets don't have a role here. We obviously have to move towards greener technology as we make new investment. But in terms of replacing the old investment, industrial countries may have a bigger role to play, especially because they bear more responsibility for the carbon that's out there. I would also argue that apart from this increase in investment, we also have to be very, very cognizant of the limits of monetary policy, which I think we've sort of been less careful about in the last few years. I would argue that with very low interest rates, distortions increase, and you may not get the effects that you want, that cutting interest rates so low may have consequences that we don't fully understand, and one has to be very careful about sustained unidirectional, unconventional monetary policy. That also means that when a country embarks on this, we need more rules of the game. Today, the country just looks at whether it makes sense for itself, because all central banks have only domestic mandates. We don't look at what happens across the world when we have a particular policy. We only look at it indirectly in the sense that if I do damage to some other country across the world and that country imports less of my stuff, that is going to be a problem. That's the indirect way we take into account what the effects will be, but we don't take into account the direct effects. So I would argue going forward in this interconnected world, because capital is so fungible across borders, because it moves with rapidity across borders, monetary policy in large countries affects everyone. And therefore, increasingly, we should discuss what the effects of our policies are on others and figure out a way that we limit the long-term spillovers to other countries. We need rules of the game. We need rules of the game which tell us what is allowable, what is not allowable, and we need an impartial umpire in the world to say, your policies are doing more damage than good, and your policies are okay. That means rethinking the global financial architecture in a way that, that satisfies everyone and puts us on a better path. Happy to elaborate as we go forward. Lastly, and soon, we need better global safety nets. Let's assume we can't do anything about monetary policy. Countries will do what they want. But this global capital going into a country and then rushing out creates enormous problems for countries in terms of their ability to handle that kind of capital. Many countries need liquidity at times when the capital is rushing out. But the global system is not well designed to provide that liquidity. Yes, you can go to the IMF, but countries have a big political problem in going to the IMF. They typically go too late for the kind of support that they need. Could there be better global safety nets without the kind of stigma that is there in approaching the IMF? Could central banks, for example, work out inter-central bank swaps that would work to bolster a country that is in trouble and help it negotiate the difficulties? For example, we have a swap arrangement with Japan, and we also have a swap arrangement with Sri Lanka. Sri Lanka actually called on the swap in order to deal with temporary difficulties that it had. We lent it $1.5 billion. So the point is, could this be a more generalized arrangement without neighbors have to look for themselves, but also have the international community work together to provide these lines? Again, I'd be happy to talk about that. And lastly, in this global economy, which is getting integrated in ways that were unimaginable a few years ago, there is a sort of vacuum in terms of global governance. I mean, historically, the United States provided the kind of leadership, creating the kind of institutions. Of course, we all have questions sometimes about whether those institutions were impartial and so on. But nevertheless, the global governance, there's an entity thinking about what had to be done next. But we find that no longer do we see a kind of consensus on how to navigate, how to govern global arrangements. There's a vacuum. The United States, having gotten entangled outside more than it desired, is perhaps backing away a little bit from driving change. And emerging markets, which have gotten a lot bigger, haven't stepped forward to fill that vacuum. And Europe is very focused on its own internal problems. And as a result, nobody really is looking out for the global economy. So the question is, can the emerging markets, who clearly are going to be a bigger part of the globe going forward, willing to take more responsibility? Willing to take more responsibility in determining the agenda for global governance. Now, we always keep talking about quota in the IMF, in the World Bank, about reform and so on. That certainly is important. That certainly is important. But we also need to provide ideas to the world about how we want it to change. And that's where we're lacking. I mean, our think tanks, our universities have to really step up to the plate to give our ideas to the world. How do we want the world to look? Thus far, we are much more reactionary. Agenda is set in Washington or in Frankfurt or in London, and that agenda comes to us when we react to it. But we rarely set the agenda. And it's time that as we grow bigger, we set the agenda, which means we take more global responsibility, but we also build capacity in our countries to provide the ideas that the global economy needs. So, bottom line, and this is where I end, lots of demand for growth. Policies that add to global growth would be better, but we haven't really discovered those policies. Maybe they're around the corner, but we've largely succumbed to policies that shift growth from one country to another. So while we've stayed away from protectionism, and that's not something that we can be assured about, if we have more years of growth, slow growth, we may descend into that. We certainly have descended into comparative easing across countries. Comparative monetary easing attempts to depreciate the exchange rate. And at this time when each country has significant problems, it's not willing to look out to the global economy to see what's best. And we really haven't been looking at what are globally optimal policies. So this is in a sense a plea for a discussion of what is globally optimal. Let's try and work on how we manage that. And that requires not just the industrial countries rethinking what they're doing, but emerging markets rethinking how they can play a more constructive role in the global economy. Let me stop there. Thank you.
Thank you, Dr. Rajan, for that tremendous exposition on a very wide global canvas. Comprehensive as it was, I found it very comprehensible also to somebody like me who's not a trained economist. So very, very well explained. The sustainability of growth and sustained growth, I think both aspects looked at from different perspectives. And also somewhere underlying that, as I picked it up, and I'm sure there might be questions on this, a plea for looking at monetary policy in different countries as part of the global commons in some sense. And therefore, whether you're looking really at an empowered global regulator to look at some of these issues. I don't know whether that was part of what Dr. Raj was hinting at, but somewhere there clearly the need to look at what one country does and its impacts on others. Very, very comprehensive. Dr. Rajan, as I said earlier, has kindly agreed to take questions. I would only request before we get the questions to make your questions very brief, please, because we'd like to get as many as possible. And all of us love to have our views on various things, so please keep the views out and let's try and get a sharp question going. And we'll start off with questions, and I see a lot of hands up, so we'll fix all of them and start. Yes, so back there, your hand is up first, so we'll start with you. There are some microphones around. Once again, please make the question.
Thank you very much. Dr. Rajan, thank you very, very much. I would have begun by finding a correlation between the two Rajans because of the kind of two economies that you run. But what I'll do, my name is Bohidar and I'm a member of the Habitat Center. I run a very modest initiative which I call Democracy Within a Continuum, in which socio-cultural symbiogenesis is a major strand. So my question to you is to expand that talk of yours, which is excellent, to just two areas. What would be your opinion or view on banking exposure to genetically modified foods and space exploration? I would like to know the quantum, currently, quality that might be, and your views on both.
Banking exposure?
Yeah, I mean, what kind of investments do you see in the coming, if the developing countries are to step up to the plate?
Well, I think that there are some questions about genetically modified food across countries.
Yeah.
And so, that would be a source of uncertainty. But if the way is cleared in a particular country, I don't see why banks wouldn't take exposure in lending to production of those foods. It depends, different countries. Europe is a little more averse to it than, say, the United States. On space exploration, it seems something like equity-funded venture rather than a debt-funded venture. It's so uncertain that given the enormous risks, it's almost not even an equity-funded venture, it's a charitable venture, right? You're spending money with very low hope of return, but to expand knowledge, expand the human experience. So
You don't see it as an expansion of the definition of the habitat?
No, it could well be, but it just doesn't seem to me that's something that the banks would see as getting a return. It's more something that Elon Musk would do.
Yes. Thank you. Let me move to this side. Yes, out here. Nisha?
Thank you. Nisha Agarwal from Oxfam, India. Thank you, Dr. Rajan, for a really wonderful lecture. You've been talking about inequality, but you touched on it very briefly. And is it not one of the reasons why global demand is so low, the fact that inequality is rising and is so high, and 1% of the global population now owns 50% of the wealth? There's only so many yachts and so many helicopters people can buy, and the demand at the bottom is just not there. So in terms of global governance, the whole idea of a global body to coordinate the tax regime and stop the level of tax evasion, close to $100 billion, which is the total amount of aid, etc., and getting that money back, which you had talked about in the context of the big crisis, but Right now you didn't talk about it so much, whether there's such a need for that.
So, obviously, as I go along, I drop bits and pieces. But you're right, certainly a source of concern. But it's not obvious that that's a reason for demand. It's a possible reason for the reason you said, that consumption, marginal propensity to consume at low incomes is higher than at high incomes. But across the world, inequality has actually fallen. This is a point that Surjit Bala has made often, but I think is important to note that as the China, India, and other emerging markets increase in wealth, across countries, inequality has fallen. Within countries, but again, there one could argue that in industrial countries, yes, inequality has risen, but many of the relatively poor are actually significantly better off than subsistence levels. So it's not that the effect, the marginal propensity effect that I said is that big. Maybe, but it's hard to imagine that increased so much over the last 5 or 6 years to explain the significant slowdown. I don't know.
Yes, please. Yeah, back in center. Yeah, please.
Dr. Rajan, you spoke about the global economy without touching the burning problems of India, such as high rate of inflation, how to control it, high rate of Indian indebtedness to the foreign countries and banks to the tune of $12 trillion India owes to foreign lands, and how to get rid of this. You also did not talk about falling rate of Indian rupee in comparison to the dollar, yen, and euros. And lastly, the banks, Indian government banks, are having very bad loans given to the public sector undertakings, which are not recoverable. And our economy is rated B minus, which is very close.
I think we get the thrust of your question. We'll give Dr. Rajan some time to answer it. We get the thrust of where you're going. So thank you. Thank you very much, please. Thank you.
Yes, it is.
Thank you. We let him answer.
So it is
Let him
very
answer, please.
close to.
Sir, excuse me, we've understood your question. Can you please let him answer?
Yeah. Well, first, there are some discrepancies in your statements. One is, of course, we don't owe $12 trillion of debt. We owe significantly less, maybe 300, 400, depending on how you count, billion, which is about 1/30th of that number. The other, it is true that we have some problems. You mentioned some of them. Inflation is coming down, but it's still higher than the rest of the world. We're sort of at work on it. Reason I didn't talk about some of these things is I've talked about them pretty, quite widely. And so I thought, following our chairman's request, I'd speak more on the international situation. We're far from, we're actually improving. There are challenges, absolutely. You pointed to some of them, the indebtedness of the corporate sector, the bad debts in the banking sector. We've got to just roll up our sleeves and work at them to bring them down. But I don't think that's a cause for despair.
There's a young lady up here in front. Yes, please.
Hello, sir. I'm from RICS School of Built Environment, Amity University. So I have a question regarding, you said in your talk that to increase growth in a country, emerging country like India, we need to focus on infrastructure investment. Plus, you added on that the capital flows between various nations can lead to fragile growth. So I have this query in my mind that how do you think can the financing of this massive infrastructure investment can be done in a country like India?
Very good question, and the answer has to be we have to increase domestic savings. We have to finance most of it ourselves, and as I said, there are pieces that we could get financed outside, such as the risk. We find it harder to finance risk in our country, and so better to get foreigners who have more experience there to finance that kind of risk. That is also partly why we put restrictions on too much debt flowing in, but are more open to equity inflows, because equity is more risk-bearing. Similarly, private equity, foreign direct investment, those are all things we're open to. And the idea is let the flows come in the places where we have the least capacity to provide savings, but also encourage domestic savings as we go along. And so, things like the recent gold initiative would be a way of weaning households away from gold into financial savings.
Thank you. I see a lot of hands, so please, questions very briefly. Up here, Amita. Yeah, please.
Thank you. Given the context of indebtedness and also the NPAs that you often talk about, what is your take on all this hype around CSR? Is it going to save the world or India?
Hype around CSR?
Yeah, all the hype around.
Oh, CSR?
Yeah.
CSR can be quite useful if employed by companies in areas they know well, but they, have an ability to do public service there, right? CSR by a company in an area it doesn't know at all, or CSR as part of the expenses that the company should legitimately be incurring, but sort of relabels as CSR. Those I think would be less useful. But I think it's less to do with debt than it's part of our what we're trying to enhance our social fabric.
So many hands up. I start from that extreme. Yes, please.
Thank you so much, Dr. Rajan, for what you're doing for the country and the free world, and Dr. Kumar, based in McLean, Virginia, and Washington. I have one basic question because I work in this area. How do you see the standoff or striking the right balance between financial inclusion and financial integrity? Because on one hand, financial inclusion is supposed to ensure financial integrity, but there are dangers that financial inclusion may also exacerbate the threats to financial integrity. So how do you make prescriptions, and what sort of views do you have on that? Thanks.
Just two immediate reactions. One, financial inclusion and, in a sense, financial stability. We saw with the subprime crisis that lending to people who have little money can sometimes go off track in a very significant way, taking them down and far away, because those people bought houses they could never afford and now are living with the consequences of their over-indebtedness, right? So we have to be very careful that as we include people, they can handle credit. And that's why I keep saying nowadays that the sequence should be payments, savings, insurance, other products, investment products, and at the end of the road, credit, rather than lead with credit and then find that you have over-indebtedness, as we found, for example, in Andhra Pradesh, or we found with the subprime crisis. So that's one aspect of it. Second aspect of it is financial inclusion means reaching the unsophisticated. And, unsophisticated are fairly, maybe unsophisticated about finance, but maybe sophisticated in other ways. Nevertheless, it may be easier to prey on them, which is why attempts at expanding financial inclusion should also include financial protection or consumer protection and financial literacy. We have to work on both. And that's the challenge we face today in India. We, at the RBI, are trying to figure out ways how to improve both. One of the things we find, for example, is customer complaints are far fewer from rural areas. But it's hard for me to imagine that rural customer is more satisfied than the urban customer who sort of can always walk to the branch and thump on the desk and say, why haven't you done what I needed. And my guess is there's a lot of hidden dissatisfaction perhaps that we're not picking up. So we need to strengthen our consumer protection as well as grievance redressal all across the country.
Yes, please. Yeah.
Hi, Dr. Rajan. I'm asking this question because you talked about the importance of green technology. So with the solar investment tax credit sort of set to expire in the US in 2016 and fracking and horizontal drilling sort of becoming, like more and more sophisticated in the US, how do you see that sort of affecting energy economics, not just in the US but around the world as well?
Well, I think the ideal thing there would be carbon taxes. But carbon taxes are a political third rail in the United States. Nobody wants to touch them. And therefore you have some subsidies, etc. Ideally what you'd want to do is put a tax on pollution and then let the best technologies win rather than offer more subsidies here and there. But it is important that people know that tax is there to stay. If it's a temporary tax, then nobody wants to make the long-term investments.
How do you see it affecting like the rest of the world as well, like in terms of like energy economics?
Well, I mean, look, the US is the hotbed of innovation. And so to the extent that renewable energy sources are less favored there for any reason, you might expect less innovation and less innovation to be transmitted across the world. I mean, this is the burden that the United States bears in a sense, that it has to incentivize innovation even if it doesn't fully capture the benefits. It does, those benefits are captured by the rest of the globe.
Yeah, please, the young lady who volunteered to pass on.
Could you talk about the Asian Investment Infrastructure Bank in the context of the global economic reforms? There have been a lot of questions posed on the investment and standards of China. So do we really see it as a ray of hope in the global governance framework?
I think that the institutions that China has taken a lead in creating, but also things like the BRICS Band, are, I think, important in that they say to the industrial world that there are alternative sources of finance that we can generate ourselves if you're not moving forward. Ideally, I think India has a stake in strong multilateral institutions, not regional but multilateral, because eventually we care about having open markets in energy, open markets in commodities. We are a very dependent country on the global economy. And so for us, a multilateral system that works well is very important. But to the extent that regional institutions are a way to strengthen the multilateral institutions by posing competition which forces the multilateral institutions to change, I think it's a good thing.
Yes, up here in front. Yes.
Hello, sir. You have been recently saying about new global economic order and new rules of the game. So my question is, what incentives are there for international community to have it, and why everyone should want all of them or not most of them, if not to come out of that route? You said no one wants to come out.
No, a good question. And this is where I point to the prisoner's dilemma nature of the problem, right? What is a prisoner's dilemma? For those of you who study economics, there are two prisoners, one in each cell, okay? And it's better that neither confesses, because then they have to be let go, right? But if one confesses and the other doesn't, the one who doesn't is punished very severely, right? And it turns out in this kind of situation where you don't know what the other guy is doing, if you're let go, if you confess but the other guy doesn't, you have an incentive to confess. And the bad equilibrium is both guys confess, both guys are executed, while in fact they'd be better off neither person confessing, right? So the point here is that there may be situations where you both end up doing the wrong thing. And that's the example I was giving of monetary policy, extremely accommodative monetary policy. You don't want to come out of it because as you come out of it, your exchange rate appreciates tremendously. And therefore your growth slows. So you want to continue the extremely accommodative monetary policy. The other guy wants you to come out, but doesn't want to come out himself. And similarly, you want the other guy to come out, but you want to come after the other guy comes out. And as a result, we may be stuck in these policies for too long. Now, I think the Federal Reserve has been making noises about coming out in December. Let's see what happens. But the point is, we may have policies that have the nature of a prisoner's dilemma. In those kinds of situations, better to agree to rules of the game. If these are the conditions, we will both agree to come out. Maybe in sequence, maybe in this thing, but we will come out. And we will not stay in these kinds of conditions. So rules help under those circumstances. It makes sense for both sides to agree because it makes them both better off. So if we as prisoners agreed, both, we signed a blood oath not to confess, we actually would be better off because we'd both be let free.
Sir, Vanakkam. என்னோட பேர் தமிழ் செல்வன். Sir, my name is Tamil Selvan. I seek your advice. How to equalize our Indian rupee to US dollar or in that case UK pound? Thank you.
How to equalize Indian rupee to US dollar? We can just redenominate the rupee, divide or multiply by 67, issue a new rupee. One new rupee is equal to 65.76 US dollars as of today. That would do it. But I think, taking your question seriously, how do we maintain a stable exchange rate? And that is really by bringing down inflation. Today, the US dollar is inflating at 1.5%. If we brought inflation down to that level, I don't think people want that low level of inflation because it has other consequences. But if we brought it down to that level, we'd maintain parity with the US.
For a very well articulated lecture, but what really has been bothering us for decades now is now we are strengthening global economic governance, but what is the problem here is we are not strengthening local economic governance. Now, for instance, we have mass hunger deaths, but we are not creating silos. You talked of creating infrastructure, but decades after decades we are talking of siloed food granary, but it's not happening.
I just heard a proposal for people were going out to actually build silos. I don't remember exactly where it was, but last week I heard of some proposals. So it's on its way.
Years has gone by and people are dying of hunger.
I think change is coming. I mean, of course, we are all impatient with the pace of change. We would want it to be done yesterday. You're absolutely right. We should have built silos in the past. But we also didn't have the logistics to take stuff from the silos into the bigger markets. We needed strong markets. Things are changing. They're coming together. Hopefully, you will see silos in the next year or two.
Yes, please. The lady here. Yes, you've been waiting for a long time. I think. Yes, please go ahead. We're running out of time. I'm sorry I'm going to be able to take only one, maybe two questions after this. But
well, thank you, sir, for a very nice talk. My question is regarding some of the protectionist measures that you did hint during your talk. Could you specify what kind of protectionist measures could countries take to make their own environments and, of course, the overall global financial environment a little more stronger than it is as of now?
This is raising tariffs on imports, which under various guises could reappear in a big way. But there are also protectionist measures against the free flow of people. Immigration is becoming a very big issue across the world, and obviously a lot of it is motivated by humanitarian sort of needs, but some of it is motivated by economic needs, and increasingly we are seeing growing intolerance towards immigration across the world.
Thank you, sir. Good evening, Dr. Rajan. You mentioned so many times Japan in your speech. So I would like to ask, Japanese Prime Minister Shinzo Abe started policy called Abenomics, which comprises of structural reform, monetary reform, and fiscal reform. So what kind of reform India needed most to propel its growth? And another question, in which reform you feel comfort to implement it without any hindrance?
I think the Prime Minister gave a speech this morning where he laid out the various pathways for economic reform that India was looking at. I think that's a comprehensive speech, and I think that lays out in a fair amount of detail. And to some extent, the Prime Minister is relying much less on Mr. Abe's first and second arrow, which is fiscal stimulus and monetary stimulus. Of course, that's part of the overall theme, but he's also much focused on the third arrow, which is structural reforms in a variety of areas. So I think better read his speech tomorrow morning.
Thank you. Yes, Mr. Reddy, you have been waiting a long time.
Okay, first of all, thank you so much for the excellent talk. I am Dr. Kasturi Das from IIT Ghaziabad. You mentioned something of an impartial umpire. Which organization do you foresee would play that role, and can we really have an impartial umpire? I mean, my emphasis is on impartiality.
Yeah, no, it's a very good question. It's a very good question, and the answer is we will need first changes in the governance of multilateral organizations so that over time they're seen as more impartial. See, legitimacy is not just about the actuality of having votes and quotas, but it's also about the perception that you are broadly even-handed. And I think, having worked in a multilateral organization, the multilateral organization have to work at being seen as impartial, and there are many areas of the world where they're not. And I think more work needs to be done. I think there are lots of, well-thinking people in those organizations, but we need them to have a governance structure which gives not just the appearance but the reality of being impartial.
I know there are lots of hands up, and I've been sort of focusing on the fringes, which is now very popular to do, look at the fringes. So let me spend just two last questions at the center, and I would request them both to be brief, please. Yes, sir, you, and then I know you've been waiting a long time. So we'll start with them, and we'll come to you. Yours will be the last question, so you have the last word in a sense. Please.
Good evening, Mr. Rajan. Nobody asked this, I'm sure, that's why I'm asking. You have always a distance from the government, and the government always try to say, or put a words in your mouth for repo or reverse repo or interest rate, and you are not agree with them. So, with your tolerance. So what do you want to say?
I have agreed a number of times with suggestions. That's why we have had 125 basis points of rate cuts so far. So to argue that I have never agreed is not. I think the government and the RBI have a respectful relationship. We obviously are a part of the overall government structure in a sense. The Prime Minister and the Finance Minister appoint me. So we are under that umbrella, but they're also very respectful that where it comes to monetary policy decisions, the decision stays with the Reserve Bank. The Reserve Bank makes the decision, while the government can always offer suggestions as to which way it thinks it should go. Sometimes based on our analysis of the models which they don't have, and our discussion with a variety of key stakeholders, we make a decision which accords with the government's view. Sometimes it doesn't. But I think the government respects the need for us to make our own decision, and therefore the decision is ours, not theirs.
The very last question, please. Yes, please, sir.
For people who are not standing up, I have an infirmity that prevents me from doing so. My name is Ranjit Banerjee. I was the seat of the Indian chair in the IMF at the same time as you were there. So I think this question should not surprise you too much. The fact is that today we are seeing a situation in the world, in the IMF, G20 is quite different from what it was, what we've ever seen before. Now the question is that you made a statement, which I think you're the first central banker I've heard make a statement that monetary policy has its limitations. It can have its limitations. So I spoke about it. Hello, this time it is different. This time it is different. And coming down to it is a book by your comment that debt, often a build-up of debt can stop countries from growing. Now, we have to be slightly careful about this. I know that there's a lot of things that have been written about your predecessor Ken Rogoff and Carmen Reinhardt in the book that is wrote, where they showed 90% of the GDP as a cut-off margin beyond which growth slows down. The question is that I think in no one's case the growth does not slow down if debt is over excessive. The question is when? 200% of Japan, is it too much? 100% of Italy, is that too much? 90% of US, is that too much? I think we should need a more nuanced view on that. On my part, I'm a saltwater economist, so I mean, what like your views?
I'm not going to say there's an immediate correlation with a particular level of debt and slower growth. Obviously, it depends on what the debt is used for. And if there is very productive investment which is undertaken, it may be possible to service higher levels of debt. But typically, when you go to those levels of debt, you're really not financing very productive investment. That's why you may find a correlation with slow growth as debt levels increase. So that's about as decent an answer.
My apologies to all those who have many questions there, but we have Dr. Rajan up way beyond the time I promised him, so I just have to end here. I'm just going to request our director, Mr. Kakkar, to close us off before we end.
Thank you, Dr. Rajan, for a wonderful evening. As you can make out from the reactions of the audience, they have enjoyed your lecture, and I think they've also benefited from the great patience with which you have answered their questions. I would like to present to you a small token of our affection. I would also like to thank all the members of the governor's staff who have worked very closely with us in putting this program together. I would like to thank our president, Mr. Karnik, who has led this idea and this program, as in so many other things. I would also like to thank all my colleagues in the India Habitat Center office, who have in their different ways contributed to the program today. My colleagues also in the program desk, in Old World Hospitality, who have also worked hard to put everything together. My apologies to the audience who had to wait for a long time to get in. We had a problem with the previous program. This happens quite often, and so we couldn't allow you in till the previous program was over and we made the arrangements for the new program. But I'd like to thank all of you for coming today, recognizing the pre-Diwali celebrations and the traffic problems. It's really heartening to see you coming up in such large numbers. Lastly, I would like to thank the members of the media also who have come here in large numbers. And we do hope we'll see all of you more often in future. Thank you.